Right, hello. So we are talking here about property, and it's a bit interesting with the company with property. I've just asked you to sort of work through the leases, the lease premium, and the rent, and that's what's going on over there. And I also mentioned earlier on that when you buy rental property, the interest payable is not allowed as as property income expense, so it has to be dealt with under the loan relationship rules, right? So that's kind of that would go under your interest sort of band, so to speak, or your interest bracket, right? Not your trading, right? Or not your not in your property, but in your interest. Because remember, of course, we have trading, we have interest, and we have property, yes, and then we have chargeable gains. So they're telling you don't deal with it here, deal with the interest. Okay, great. Now property losses. Um, this is interesting here because they're telling you here that with property losses, which was very unusual because we couldn't do this with a sole trader. So with property losses, you can offset property losses against your total profits before your QCDs. So let's just go back up a bit just to sort of see what's going on here. Just to show you, I just want to get the table very quickly. Yes, here we are. Just here. So this is where this is our total profits over here. So they're telling us that if we make a loss here, we can offset this loss against these guys, right? Before, of course. So we can't deduct this off first because you see the argument, if you're allowed to deduct QCDs as part of the normal expense, of course, there'll be less profit. So the argument is you'll have more property losses sort of waiting, sitting, that you can sort of carry forward. But they're like, no, use that loss. You can use that loss against your existing, if you like, other incomes, so to speak, which you can't do for your as a sole trader. Because a sole trader, you have to just carry it forward, and you can only carry it forward against property income, right? So you can't use it, but as a company. And I guess the argument typically is that for properties, it is to do with trade, or they just have a better lobby group. I've always tried to rationalize it that way. So let's just go back here to see what is going on. When I got here, so we had, yes, so here we are. So you can offset that against your total profits before your QCD. So it's possible that your QCDs may get wasted. Now, what's also interesting is you can carry it forward against your total profits. So you're not restricted to just carrying it against property income of the next year. And this treatment is automatic. It just happens naturally. And let's quickly knock out the rest. I talked about patent royalties. You're unlikely to see that in the exam. Dividends income. Again, if you talk about dividend income, think about it as coming from another company. The other company that has already has had its profits, if you like, taxed, and then whatever's left, they share their dividend. And you as an investor will receive this dividend out of tax profits. It'll be a bit unfair to tax it again, so you include it when it comes to calculating your own corporation tax. So you don't include it as income or anything. No, you don't, right? It totally exclude it because it's come out of tax profits. Again, this idea of a QCD, typically, I think I highlighted what these were really, and QCDs really are large donations to large charities or national charities. Think of it that way, to national charities. Classic examples of national charity. But typically, only small local donations are allowed as trading expenses, right? And then the rest, and then QCDs are national sort of donations. Now, if QCDs exceed total profits, there's no relief. So, I mean, when I say excess relief, QCDs can't make your total profits even worse. So that's just it. We'll see. Hopefully, you'll do an exercise soon. I thought there was a question here after this. No, there isn't. Okay, great. So, yes, up till now, this has been pretty straightforward, as in because every time it's always been 20%. FY 2017, it's now 19%. And so let's quickly look at these years. For example, if we talk about the Finance Act, whatever 15, that's really the year that runs 1st of April 15 to the 31st of March 16. We call this the Finance Act 15 applies in this period. So right, so the FA 16 Act applies from the 1st of April 16 to the 31st of March 17, and so on and so forth. Whoops. Right, and so on and so forth. Right. So when tax was just 20%, it didn't really matter. We never had what we refer to as a straddle problem, right? Never had that issue because, if you like, because if it's 20% here and it's 20% here, it doesn't matter if you pay your accounts. I've changed my pen color. It doesn't matter if you pay your accounts over a period that overlaps, if you like, the 31st of March and the 1st of April. So let me explain. Let's use the notes to kind of explain what's going. Let's use this area to explain. So say, for example, let's just have it, if you like, the 1st of April 2016. Well, this is a good example now to the 31st of March 2017. Have the 1st of April 2017 to the 1st of March 2018. Let me put my pen color now. So we have a scenario where you have prepared the 1st of January 2017 to the 31st of December 2018. Now, like I said, the corporation tax here was 20%, Finance Act 16. Okay, we have Finance Act 17, and the corporation tax here is 19%. So what you have to do is you have to take the first 3 months here of your chargeable accounting period and tax that at 20%. 9 months that's left, you have to tax it 19%. So you apportion your profits and tax appropriately. Good. So, let's just do this to see what's going on here. As an example, do that example and that. Actually, do both. I remember doing example. I remember talking about example 5. So, example 5. Remember, don't get waylaid by dividends. We don't include that in your calculation. So, deal with that. Please do that example. And example 6 allows us to see this idea of the straddle, to deal with the straddle. So, do that. Then here we are. So, this talks about what I was saying earlier on, that we have to separate the period, right? So this is this thing of a long period of account. You can't have anything longer than 12 months. So what they're really saying in the first 12 months, but you have to deal with things fairly in 3 months here. So they're telling you in terms of profits, so if it's you split it over the 12 months and 3 months. Capital allowances, like I said, you will deal with that in its natural way. Do 12 months, do the tax written down value, carry that forward, and then carry on. And then interest income, you just do your rental income through and split over the 15-month period as well, if depending on how you collect your rent, just work with it. And then any chargeable gains, just deal with it in the period as it appears. And any QCDs, deal with in the period as they appear. And pretty much that's that. So, of course, you will have two separate calculations because they are 2 separate chargeable accounting periods. Right, and so please go through example 7. I think I asked you to do that for homework, and that brings us nicely to the end of chapter 13. Cool, great stuff. I'll see you in chapter 14 is on something else, but chapter 15 takes us into losses. Yes. Okay, great. See you there.